Here's something the financial press covers every single day and somehow still manages to get completely wrong. They'll tell you money is printed, money is spent, and money flows through the economy. And technically, none of that is false, but it's not what's actually happening. Because the story they're telling you, the one about the Fed printing money and handing it to banks, that's a metaphor. And at some point, the metaphor became the explanation. And that, right there, is the problem. Because if you have a 401k, a savings account, a mortgage, or a paycheck, and I'm going to go ahead and assume that's you, then the actual mechanics of how money moves through this system are silently determining your financial life. And you've likely never heard the real version explained. So let's fix that. But to understand how money moves, you first have to understand what money actually is. And here's where most people's mental model quietly breaks. Most people picture a dollar as a thing, a physical object, or maybe a digital version of one, printed in Washington, shipped to banks, lent out to consumers, clean, linear, logical. And that's not what this was, because the dollar in your bank account right now, it was never printed. It was created by a bank the moment someone else took out a loan. Stay with me, because this is the mechanism nobody is talking about. Here's how it worked. Meet Bob. Bob walks into a bank and borrows $100,000 to buy a house. The bank doesn't go into a vault, pull out $100,000 in cash, and hand it to Bob. The bank opens a ledger, types in $100,000 on Bob's behalf, and that money, that brand new $100,000, now exists. It didn't exist before Bob signed the loan document. The bank created it because Bob promised to pay it back. This is called fractional reserve banking, and it is the actual engine of the modern money supply, not the printing press. And this is where the Federal Reserve enters the story. Because the Fed isn't really a money printer. It's a rate setter. It's a plumber. It controls the cost of creating money, not the creation itself. When the Fed raises interest rates, it makes it more expensive for banks to create new dollars because it becomes more expensive for Bob to borrow. Less borrowing means less money creation, means less money in circulation, means inflation, the price of everything, theoretically cools down. And when the Fed cuts rates, it runs the same machine in reverse. But here's where the official explanation starts to break, because the Fed doesn't directly control your borrowing rate. It controls the federal funds rate, the rate banks charge each other to borrow overnight. And I promise you that payoff is coming in a moment, because that single sentence is why your mortgage rate and the Fed rate are not the same number. The transmission mechanism, the actual pipe, is a chain of incentives, spreads, and risk calculations that runs from the Federal Open Market Committee in Washington all the way down to your credit score. Every link in that chain takes a cut. Every link in that chain can break. And here's the part that should make you a little uncomfortable. When the Fed created trillions in new reserves during 2020 and 2021, the so-called money printing you've heard about, most of that money didn't flow into the economy the way people assumed. It flowed into bank reserves, sitting idle at the Fed, earning interest. The velocity of money, how fast a dollar moves through the economy and changes hands, actually fell. The flood of cash that was supposed to cause inflation, it didn't cause the inflation that came. The inflation came from something far simpler. Too few goods, because supply chains broke while demand stayed intact because of stimulus checks. Those checks were new money injected directly into consumer accounts. That's the pipe that worked. The rest was theater. And this matters because you've been watching the wrong pipe. The real plumbing of the economy isn't the one on CNBC. It's the interbank lending market, the repo market, the treasury securities market, the money market funds that hold your cash and invest it overnight. It's 13 layers of intermediaries between a decision made in a marble building in Washington and the interest rate you got quoted on your car loan last Tuesday. Understanding this doesn't make you a cynic. It makes you someone who knows where to actually look when something in the economy goes wrong. And right now, between rate uncertainty, commercial real estate stress, and a federal deficit that's compounding faster than at almost any point in modern history, knowing where to look matters, because the pipe is under pressure, and most people still think it's a faucet.